Imagine watching the executives of a $44 billion cloud software giant systematically sell off like $38 million of their own stock.
Right. Just in a single month.
Yeah, in 1 month. I mean, your gut reaction is probably to just run the other way, right?
Oh, absolutely. You'd think the sky is falling.
But then you look at Wall Street, and nearly 90% of the analysts covering that exact same company are just pounding the table. They're completely unfazed, screaming, buy.
Which is, it is the ultimate 2026 valuation puzzle. You've got this undeniable fundamental business strength just colliding head on with this astronomical price tag and, executive cash outs.
So welcome to a brand new deep dive. Today, we have a really specific mission for you listening. We are stepping directly into the shoes of a Wall Street stock analyst.
Grab your spreadsheets.
Exactly. Together, we are going to build a comprehensive, data-driven 2026 investment thesis for Datadog. Ticker symbol is DDOG.
And before we rip into the financials, we do need to make one thing crystal clear for you.
Right, the disclaimer.
Yeah. While we are dissecting real market data today, this deep dive is strictly for entertainment and educational purposes only. Always consult a professional financial advisor for your own specific portfolio.
Exactly. We're here to, analyze the mechanics of the business, not to manage your retirement fund.
Please don't let us manage your retirement fund.
Seriously. So let's lay out the source stack we have on the table today. We are pulling directly from Datadog's recent financial earnings transcripts, specifically their Q3 and Q4 25 results.
Which were wild, by the way.
Super wild. We've also got market landscape research from NAND Research, analyst tracking data from Anachart, a really detailed bear case stock analysis from the Motley Fool, and those insider trading logs we pulled straight from Benzinga.
It is a heavy stack, I won't lie. But it's necessary. I mean, if you want to figure out whether Datadog is a buy, hold, or sell for 2026, you can't just look at the top-line revenue.
Right.
You have to understand the underlying engine, like what is actually driving this thing.
Okay, let's unpack this. I'm looking at their origin story from 2010. Olivier Pommel and Alexis Lequoc founded this as a relatively simple, cloud monitoring service aimed at startups.
Yeah, just basic dashboards.
Right. And it is incredibly hard to reconcile that basic dashboard concept with the $44 billion enterprise behemoth they are today. So how do they force this evolution? Like, what is the actual mechanism of what they do right now?
Well, the mechanism is what the tech industry calls observability. But we really need to look at how that actually functions inside a modern enterprise network.
Okay, paint me a picture.
Think about the sheer complexity of a global company today. You don't just have one server sitting in a closet anymore.
No, of course not.
You've got data distributed across Amazon Web Services, Microsoft Azure, Google Cloud. You have thousands of microservices, global security protocols, and massive databases interacting like millions of times a second.
So it's basically this digital nervous system that is just entirely impossible for a human to track manually.
Precisely. And if a user clicks checkout on a company's website and the system lags by, say, 300 milliseconds, or the transaction just fails entirely.
The engineering team needs to know exactly why, and fast.
Right. And Datadog physically sits inside that network. It traces that specific user's click through the load balancer into the microservice, queries the database, and reports back.
Wow.
Yeah, so if there's a failure, Datadog isolates the exact line of code in the exact server container that caused the bottleneck in real time.
That is insane. And according to the NAND research report we have, this level of granular visibility is forcing a massive consolidation in the entire market.
Or absolutely. What's fascinating here is the shift in enterprise IT budgets. I mean, a few years ago, a massive enterprise might have had 50 different monitoring tools.
50?
Yeah, literally. One for the network, one for application performance, one for database health, one for cloud costs.
Yeah.
And NAND research points out that this is just no longer viable.
Because it's too expensive.
Too expensive. And honestly, more importantly, it creates blind spots.
Yeah.
The tools don't talk to each other.
Oh, right. So the enterprise buyer is looking at their IT budget and saying, I want one unified platform to rule them all.
That is the exact dynamic. And Datadog, alongside its primary enterprise competitor, Dynatrace, are just fiercely capturing this market because they offer that all-in-one consolidated dashboard.
So you don't need 50 vendors anymore. You just need Datadog or Dynatrace.
Exactly. But the real fuel on the fire, the reason they are commanding such intense Wall Street attention for 2026 is artificial intelligence.
Yes, this is what I want to understand. The how. Why is an infrastructure monitor suddenly the critical bottleneck for the entire AI boom?
because AI adds a completely unprecedented layer of chaos to that digital nervous system we were just talking about. Over the last 2 years, companies have rushed to deploy autonomous AI agents.
Right. Everyone has an AI agent now.
But you cannot just release a large language model into your proprietary network and assume it's going to behave perfectly. It's too unpredictable.
Okay, I'm trying to visualize this. If a company deploys an AI agent as, like, a digital security guard or a customer service rep, the old analogy was that Datadog is the security camera watching the guard.
Right, that was the old way of thinking about it.
But based on the LLM integrations they are building now, it sounds much deeper than just a camera.
It is so much deeper. It's not just a camera in the corner of the room. Datadog is a system that instantly reads the guard's pulse, monitors their radio frequencies, and can tell you exactly which brain synapse misfired to make them hallucinate that a loyal customer was a threat.
Wait, how does it actually do that with an AI model?
Through what Datadog calls LLM spans.
LLM spans, okay.
Yeah. When an AI agent makes a decision, it isn't magic, right? It's data processing. A span tracks the exact prompts the user inputted, the specific context window the AI referenced from the company's database, the token usage, which dictates the compute cost, and the final output.
Oh, wow.
And Datadog reported that the number of these LLM spans sent to their platform has quadrupled in just a few months.
Quadrupled. So if a company's AI customer service bot glitches and starts offering everybody like a 100% discount.
Which happens.
Right. Datadog doesn't just tell you the bot is broken. It tells you exactly which token sequence or database query caused the hallucination so engineers can kill it instantly.
Exactly. And they already have over 5,000 customers deeply integrated into these specific AI observability tools.
I mean, that level of infrastructure entanglement where you are tracking every single token of a company's proprietary AI that creates a massive structural dependency.
Oh, a huge moat.
Yeah, ripping Datadog out of your network at that point wouldn't just be a logistical headache.
Right.
It would essentially blind your entire AI operation.
And if we connect this to the bigger picture, that structural dependency is the exact mechanism driving their staggering financial momentum.
Which brings us perfectly to the Q3 and Q4 2025 earnings transcripts. Let's look at how that stickiness translates into actual capital. In Q3, they hit $886 million in revenue, which is a 28% year-over-year growth rate. Then in Q4, that accelerated. Revenue hit $953 million, pushing growth to 29%.
But, top-line revenue in cloud software can be super deceptive.
How so?
Well, a lot of companies grow at 30%, but they burn hundreds of millions of dollars doing it. Datadog is completely defying that trend. In Q4 alone, they generated $291 million in free cash flow.
In a single quarter.
In a single quarter. That is a 31% free cash flow margin.
For the full year of 2025, that totals $915 million in free cash flow. They are pulling almost $1 billion of actual liquid cash out of this operation.
It's a cash machine.
And looking at the transcripts, the engine behind that cash generation is their land and expand strategy.
Yeah, land and expand is basically the holy grail of software sales economics.
Break that down for us.
The mechanism works like this. Datadog lands a client with one basic module, maybe just basic infrastructure monitoring. The customer's engineers get used to the interface. Then the security team realizes they need threat detection.
So they just turn it on.
Yeah, exactly. They just turn on the Datadog Cloud SAM module. Then the application team wants performance metrics, so they turn on the APM module.
It's totally frictionless upselling.
Completely. And the data proves the thesis here. 84% of their customers now use 2 or more products.
Oh, okay.
But the truly staggering metric is that a full 16% of their entire customer base is now using 8 or more Datadog products simultaneously.
8 or more. That's incredible. And there's a perfect example of this consolidation economics in the earnings call. They highlighted a 7-figure deal with a European telco.
Right, I saw that.
Yeah, that single deal allowed the telco to decommission 10 different commercial and open source tools. I mean, the mechanism of savings there is huge. They don't just save on subscription fees.
No, they save on the compute power required to run 10 different monitoring agents.
Exactly. And the labor of training engineers on 10 different user interfaces. The telco expects to save over $1 million annually just by consolidating into Datadog.
And that scales all the way to the top of the market.
Yeah.
They also just landed a 9-figure expansion deal with a leading AI company.
9 figures, so over $100 million.
Yep. Hundreds of millions of dollars committed because that AI company simply cannot operate its infrastructure without Datadog's visibility.
Here's where it gets really interesting, though. When you dig into the Q3 call, it's not just the AI hype carrying the weight. Their digital experience products, the modules that track how human users physically interact with mobile apps and websites, just surpassed 300 million in annual recurring revenue independently.
That metric is vital for any analyst building a thesis. I mean, the transcripts show that non-AI customers actually accelerated their spending at the fastest rate seen in 12 quarters.
Meaning the core foundational business of helping traditional companies migrate to the cloud is reaccelerating, completely independent of the AI agent boom.
Exactly. It's broad-based fundamental strength across the entire product suite.
Okay, so we have thoroughly established that the underlying business is an absolute machine. They are deeply embedded, cash-generating, and dominating enterprise consolidation. But
There's always a but.
there's always a but. Execution doesn't exist in a vacuum. A phenomenal company does not automatically equal a buyable stock.
That is the hardest lesson in investing. Price matters.
It really does. So we have to look at the valuation multiples, because if you are building an investment thesis for your portfolio today, this is where the math gets incredibly aggressive.
Brace yourself.
At the current price of roughly $126.57, we are looking at a trailing PE ratio of 412.65.
412.
Yeah. And even if we look at the forward PE, which factors in all of their estimated future growth for the next year, it is still sitting at 58.44. The price-to-sales ratio is around 13.
This raises an important question about margin of safety, right?
Mm.
When investors pay a trailing PE over 400, they are pricing in a flawless future.
Absolute perfection.
Exactly. They are assuming Datadog will execute its AI rollout and enterprise consolidation without a single misstep.
And as an analyst, we need to run a 10-year discounted cash flow analysis, a DCF, to really ground this. We have to see what the intrinsic value actually is.
Oh, let's do it. A DCF is the perfect reality check here.
Okay, so we take our free cash flow base of $915 million for 2025.
Right.
And let's use a pretty conservative 9% growth expectation for operating earnings over the next 10 years.
9% makes sense, especially given their scale now. You can't model 30% growth forever.
Exactly. So if we model that 9% growth for 10 years, and then we apply a terminal value, let's use a standard 2.5% terminal growth rate.
Sure, basically pegging it to long-term GDP growth.
Right. And we discount all of that back to today using a 10% discount rate, which is, a standard required rate of return.
Standard hurdle rate, yeah.
If you run that math, the present value of those 10 years of cash flows is roughly $9 billion. And the present value of the terminal phase is around $11 billion.
So you're looking at a total enterprise value of, what, around $20 billion?
Exactly, $20 billion. But Datadog's current market cap is $44 billion.
Wow.
Yeah. So based on that DCF, the intrinsic value is roughly $55 to $60 a share, but it's trading at $126.
It had a massive premium.
It's trading at more than double its intrinsic value based on our model, and that leads us directly into the bear case mapped out in the Motley Fool report.
Right, because the primary risk isn't that Datadog is a bad company. It's that the stock is priced for hypergrowth. But management's own guidance suggests something completely different.
Let's talk about that guidance.
If you look at management's official guidance for 2026, they are forecasting total revenue between $4.06 billion and $4.10 billion.
Which implies a growth rate of, 18 to 20%?
Exactly. That is a material deceleration from the 29% growth they just posted in Q4.
That's a huge drop.
It is. This is the core tension of the valuation. You have a stock commanding a premium multiple, typically reserved for companies accelerating their top line by 30 or 40% year over year.
But the actual forecast is a slowdown to roughly 19%.
Right. And if growth drops and the market decides Datadog is no longer a hyper-growth story, that 58 forward PE can compress violently.
Multiple compression is brutal. I mean, you could have the company hit all its targets, but if Wall Street decides they only want to pay 30 times earnings instead of 60, the stock price gets cut in half. And the Motley Fool highlights another friction point on the profitability side. We just celebrated their $915 million in free cash flow. But structurally, on a GAAP basis, generally accepted accounting principles, profitability remains elusive.
Yeah, in Q3, they actually posted a GAAP operating loss of negative $6 million.
Okay, explain this to me. How do you pull nearly $1 billion in free cash flow but still run a strict accounting loss? What is the physical mechanism of that R&D spend dragging them down?
It comes down to the sheer cost of the AI arms race. Building those LLM span trackers and proprietary AI observability features requires two massive expenditures.
Okay.
First, specialized machine learning talent, which commands exorbitant salaries and heavily dilutive stock-based compensation.
Right, paying the engineers in stock.
Exactly. And second, the sheer cloud compute power required to train and run their own internal models. They are aggressively pouring capital back into the R&D engine to maintain their moat against Dynatrace.
So they have to spend it.
They do. While that is undeniably the right move for the long-term product, it keeps those strict GAAP accounting profits suppressed.
And that heavy R&D spend driving the gap losses, that directly feeds the next massive risk on the board. And this is the one that really gives me pause. Let's look at the Benzinga insider trading data.
Oh boy.
Over the last 30 days, Datadog insiders sold 341,790 shares.
It's a staggering figure.
We are talking about $38.23 million of stock sold by the exact people steering the ship. Director Shardul Shah, Chief People Officer David Gallery's key insiders liquidating.
And what were the buys?
The number of insider buys over that same period, zero.
Yeah.
Absolutely zero.
Yeah, you should weigh that carefully.
So what does this all mean? I have to push back on the bullishness here. If I'm looking at this data, I'm seeing an astronomical PE. I'm seeing an intrinsic value of like $60 from our DCF model, revenue growth decelerating to 19%, and the executive team walking out the door with $38 million while buying nothing.
Right.
Am I basically acting as exit liquidity for the C-suite at the absolute top of the AI hype cycle?
I mean, it is entirely rational to interpret the data that way. The optics of insider selling at these valuation levels are always terrible.
Really terrible.
However, to play devil's advocate for a second, insider selling is rarely a pure referendum on the company's future. Executives sell to diversify their portfolios, to pay taxes on massive stock option vests, or simply, to buy real estate.
Sure.
But you are correct that $38 million in zero-buy outflow paints a picture of, at the very least, extreme caution regarding short-term price appreciation.
And yet, if we pivot to the Anachart data tracking the professional analyst community, they're completely ignoring that caution. Wall Street seems to be looking at a completely different set of metrics.
The divergence between insider behavior and Wall Street sentiment is fascinating here. Anachart tracks 35 professional analysts actively covering Datadog.
Okay, what do they say?
Out of those 35, a massive 89.7% have a formal buy rating in the stock.
Nearly 90% are telling their clients to buy in right now, at this price.
Yes, only 9.3% say hold, and less than 1% recommend a sell. The average price target across the board is $161.22.
Okay, so based on the current $126 price, the professional consensus implies a potential upside of over 27%.
And some of the targets are much, much higher. Gil Luria from D.A. Davidson put a target of $225 on the stock. Gray Powell at BTI sits at $170.
That is wild. They are looking squarely at the 412 PE, the discount to intrinsic value, the $38 million in insider sales, the gap losses, and they are still saying this thing is going to rocket upward. Why? What is the physical mechanism they see that overrides the valuation risk?
They are focused entirely on the intrinsic leverage of the AI observability mode.
Expand on that.
Analysts like Luria don't view the AI build-out as a cyclical trend. They view it as a permanent structural shift in how software operates. Every single Fortune 500 company is going to deploy autonomous agents over the next 5 years.
Right.
Every single one of those agents requires an observability layer to prevent catastrophic hallucinations. Wall Street believes Datadog has already won that foundational layer.
So they just own the space.
Yeah, they are betting that the near-term deceleration to 19% is just a momentary breather before the massive enterprise AI budgets fully unlock, driving a huge reacceleration in 2027 and beyond.
Okay, so if we're acting as the ultimate analyst today, we have to synthesize this thesis. We have the data, we did the DCF, now we have to weigh the evidence for a final 2026 verdict.
Let's do it. The bull thesis is built on inevitability. You have a best-in-class platform generating nearly $1 billion in free cash flow. They have a flawless land and expand mechanism where 16% of customers are locked into 8 or more products.
Right, the stickiness.
Exactly. They're uniquely positioned to tax the entire AI revolution. because nobody can run an LLM without their monitoring spans. If you believe the AI transition is still in its infancy, Wall Street's 89% buy rating makes complete sense.
But the bear thesis is built on mathematical reality. You are paying a blistering 412 times trailing earnings. The DCF suggests the intrinsic value is roughly half the current share price.
Yep.
Management themselves are telling you growth is going to decelerate into the teens next year. Heavy AI compute costs are keeping JAP profitability negative. And the people who know the company's internal roadmap better than anyone, the executive just dumped $38 million of stock.
It ultimately comes down to your risk tolerance regarding multiple compression.
So what's the verdict based on our discount to intrinsic value?
Based purely on the DCF and the massive premium it's trading at, a value investor has to rate this a sell or at best a hold until the price comes down.
Yeah.
Your thesis for buying today requires their AI innovations to be so deeply embedded that growth reaccelerates massively to justify the price tag.
So, to you listening right now, you have to make the call for your own portfolio. Do you align with the 90% of Wall Street analysts who see an unstoppable cash-generating machine dominating the AI frontier?
Or do you trust the intrinsic value model?
Right. Do you trust the insider selling and the daunting PE ratio suggesting it's time to rate this a hold or sell until the valuation comes back down to earth?
It really is the defining growth versus valuation dilemma of the 2026 market.
It really is. So let's quickly wrap up the journey we've taken today. We started by tearing down Datadog's foundational tech, understanding how tracing a single user click through a maze of microservices turned a 2010 startup into a $44 billion titan.
A massive evolution.
We explored the mechanism of LLM spans and how Datadog acts as the ultimate biometric security camera for hallucinating AI agents. We analyzed their 9-figure enterprise deals and almost $1 billion in free cash flow.
The fundamentals are solid.
And then we ran headfirst into the wall of their valuation multiples, the DCF reality check, and executive stock sales, contrasting all of that with Wall Street's unwavering $225 price targets.
The comprehensive picture. But before we sign off, there is one final provocative detail buried in the Q3 transcript that completely changes the calculus for the rest of the decade.
Oh, lay it on us.
During the Q3 call, Datadog's CEO detailed the rollout of a new product called Bits AI SRE.
SRE.
Yeah, SRE stands for Site Reliability Engineer. But this isn't just an observability monitor that sends an alert when a server crashes. It is an autonomous agent.
Wait, what does that mean in practice?
The mechanism is wild. If a piece of code breaks in the middle of the night, Bits AI SRE detects the failure, reads the recent GitHub commits to find the buggy code, rolls back the deployment to stabilize the system, and then writes up the incident report in the company's Jira or Slack channel.
Hold on. It actively investigates and resolves the software issue before the human engineers even wake up and open their laptop.
Exactly. It fixes it while they sleep.
I mean, that is legitimately incredible for the customer. It's the ultimate efficiency tool.
It is. But if we connect this to the bigger picture of Datadog's revenue model,
Okay.
Datadog makes a significant portion of its money by expanding its footprint, right?
Yeah.
Adding more user seats as IT and engineering departments grow.
Oh, wow. I see where you're going.
Right. If Datadog's own AI becomes so exceptionally good that it autonomously manages incident response and practically automates the IT department, those enterprise customers are eventually going to need fewer human engineers.
That is a staggering paradox. Could Datadog's ultimate success in building perfect AI automation eventually cannibalize the very per-seat human user expansion model that made it a cash-generating giant in the first place?
It really could. They are building the exact tool that might shrink their own user base.
Wow.
It raises an incredibly important question about the long-term unintended consequences of the AI efficiency boom. When you automate the human out of the loop, you might just be automating away your own revenue streams.
That is a phenomenal thought to leave on. You know, building an investment thesis is never just about staring at a spreadsheet or running a DCF model. It's about understanding how the technology actually alters the landscape it exists in.
Exactly. You have to see the big picture.
Thank you for joining us on this deep dive. Keep looking closely at the mechanisms behind the data, keep weighing the conflicting evidence, and most importantly, keep asking the hard questions about your own investments.